International Corporate Tax. This manual will deal with the corporate tax. We will explain its type, its incentives, its exemptions, its different tax rates, as well as who administers it. This text will also be discussed on an international level, how double taxation works, what multilateral agreements exist, and what characteristics corporate tax has in Portugal, Brazil, Canada, and the United States. There is an appendix at the end of the manual with all regulations of each country and links that will help get a deeper understanding. Introduction to Spanish corporate tax. History and legislation. Well, the corporate tax is one of the most firmly established taxes in the tax system. During its long existence, it has undergone several modifications: its tax rate, what it taxes, its name, etc. Since its creation, this tax has collected and still collects large amounts of money, represents an instrument of economic policy. The corporate tax law has a number of precedents. The first one was the law of March 27, 1900 on contribution of profits. And one of the first rates that it applied the III, the mixed returns of labor and capital were taxed, and for the first time a tax on companies was established, and it later resulted in subsequent reforms. 1940, a new tax law which increased the tax rates were put forward despite appearing in the official state gazette, and its non-complete application, it involved an increase in production costs and therefore made it difficult for companies to compete and export. This increase, among other things, made this period one of the worst periods of the Spanish tax authority. Generalized and increased fiscal fraud, large rates of submerged economy, and black market really, and fiscal injustice. And until 1957, with the law of December 28th, there was no significant change in the way of paying taxes. The previous reforms, 1940, created a parallel reality in terms of taxes. Surcharges on tax rates increased while tax bases were invented based on previously known quantities. In other words, it was preferred to increase the collection on fictional base, and fiscal fraud even increased. The state educated the taxpayer in the game whose bill would be paid by the Treasury. For all this, the new law in 1957 sought to collect more, faster, and more effectively. This was achieved by dividing the contributions into three parts. The one that interests us here is the one 3, called Rate 3. It is vitally important since the corporate tax was based on it. I believe that kind of explains the earlier reference here. The Rate 3, should have probably said that. The old famous Rate 3, eh? Well, we're getting into politics here in a minute. That is vitally important since the corporate tax is based on, here comes now Franco. The industrial and commercial tax was replaced by the tax on industrial and commercial products, taxing legal entities with a fixed fee. This reform was highly successful in collecting and managing to achieve the proposed objective, which is the collection sufficiency, which would end the state budget deficit and ultimately contain inflation. With this new reform, Spain was approaching the European tendency to tax sales volume. As it will be seen later, this trend is still maintained to the extent that indirect taxes are sometimes higher than direct taxes. The next reform in 78 took place in a different scenario after Franco's death. A broad agreement between all the actors was sought in order to lay the foundations of democracy. On the other hand, instead of what we had before, which was basically totalitarian dictatorship. On the other hand, the oil crisis of 77 and the economic and labor situations of the state were also influencing efforts. The measures were obtained in improving unemployment and low business competitiveness. Along with wage moderation, it was intended to avoid any kind of tax reduction to companies that did not encourage the creation of employment. More importance was given to the direct tax, and the tax burden was increasing taxes on companies, among others, but also introducing progressivity. However, there were still unresolved issues, such as tax fraud. And before passing the current corporate tax law, there was one more reform, 95. Its innovation were deductions in some fields such as research and development to provide competitiveness to companies, the reinvestment of benefits, which promotes fiscal incentives, and the unification of the taxable event, constituting unitarily and as obtaining the income, in contrast to the previous laws which separated its origins. On the other hand, companies were generally subject to a tax of 35%. Taxation to avoid double taxation began to be considered. This law inspired the following changes, which were included in the Royal Legislative Decree, which approved the revised text of the corporate tax law, to add and unify the existing regulations, and Law 35 that partially modifies the corporate tax law and includes a gradual reduction of tax rates and adapts to international regulations regarding fiscal fraud. These modifications have essentially changed, or have made essential changes in the corporate taxation. The taxation rate has been reduced, which has been changing, but always above 30%. Currently it stands at 25%. The number of deductions designed to stimulate growth in certain activities has been reduced. The scope of the special system of SMEs has been extended. And before dealing with the corporate tax law, we will discuss where it is registered and which bodies are responsible for ensuring that companies comply with their obligations. And there's a text of the tax law, law of corporate and royal degrees, and their titles are as given. and concerning the corporate tax for non-residents, with a correction approved 1 month later. And on the other hand, the law that regulates taxes and establishes which bodies are responsible for executing sanctions or reviewing administrative compliance is the general tax law. It will also allow us to understand some concepts that will be used to discuss a corporate tax law. In Article 5, the general tax law stipulates that the state is responsible for the application, taxes, the exercise of sanctioning powers, and the review function of the administrative channels. This responsibility corresponds to the Ministry of Finance, and these competencies correspond to the tax agency, and the tax agency consists of bodies and public entities that by administrative means apply taxes, penalties, and revisions. The AEAT is, therefore, an entity attached to the Ministry of Finance, is competent in the application of the tax system and has sanctioning power in tax matters. And in this case of Spain, there is a central organization and a territorial organization in each autonomous community. The corporate tax law, as it will be seen later in detail, is a state tax, a direct tax. It taxes wealth itself, and a law that is part of the general tax law, which in turn is part of the Spanish Constitution. It is not a section, a subtitle, or a minor law. It is based on the Constitution and the general tax law, and is the supreme rule of the tax system. Principles and general legal rules that regulate the actions of the tax administration, such as double taxation, come from corporate tax. Now we move on to section 2, which is a little bit wordy, but notwithstanding. Corporate tax in Spain, part 1. This section will provide a full explanation, 74 pages of explanation apparently, of the corporate tax in Spain. Okay. Here are its features. The corporate tax is a direct tax imposed on the company's net income and other legal entities. Main features of the direct tax: taxes direct manifestations of the payment capacity of the taxpayer income, and it's a personal tax. Taxable refers to a given person who is the legal person receiving the income. It taxes the total income of the taxpayer. It taxes the income of the companies and other legal entities, as well as the income of any legal entity qualified as a taxpayer by the law that regulates it. And it is an accrued tax. It establishes tax periods to self-assess the obligations with review revenue services. And the tax is applied to the net profit, which means that the expenses to obtain the benefit should be deducted from the total income of the organization. It is therefore structured on the basis of accounting. The taxable income of the company will determine the tax base and the amount payable annually. The corporate tax is applied to the companies which are headquartered within a Spanish territory. The case of the Basque County and the Navarra are different due to their regional tax systems. And the Canary Islands, Ceuta and Melilla, have their some tax incentives. Corporate tax elements. Some concepts of the corporate tax come from the general tax law. Most relevant points to understand corporate tax law are the following points. In Article 2.1 of the general tax law, tax payments are public income consisting of cash benefits required by a public administration as a result of the existence of the fact that the law binds into duty to pay taxes, with the primary purpose of obtaining necessary income to support the public expenditures. The following articles defined the 3 types of taxes that can be found: levies, special contributions, and taxes. According to the general tax law, their taxes are: tax payments required without consideration as to the whole taxable event is constituted by business, acts, or facts that show the economic capacity of the taxpayer. And in this case, this is a corporate tax. Now we come to the main tax liability. It seeks payment of tax liability and consists of taxable events. The legal concept of a taxable event is provided in Article 20. It states that a taxable event is the budget established by the law to set each tax that results in a tax liability. It's accrual. And its law defines accrual as the moment when the taxable event occurs and when the tax liability arises. Exemptions. It is necessary to distinguish between exemptions and non-liability. Although both mean not paying taxes, they are legally distinct concepts. Here's why. Exemptions mean a taxation rule which defines a taxable event that involves tax liabilities. In addition, it involves an exemption rule that requires a tax liability not occur in some cases. On the other hand, a non-liability means that the assumption is not included in the defined regulation of the taxable event. That is, a non-liability restricts the taxable event negatively. In Article 50.1, the general tax law defines tax base as a monetary or other type of magnitude that results from the measurement or evaluation of a taxable event. The general tax law, although, also defines net tax base in Article 54, the magnitude resulting from applying the reductions established by the law of the tax base. And we come to the tax rate, and that's the figure or coefficient or percentage that is applied to the tax base to obtain the gross tax charge as a result. The main elements of the corporate tax law are: the taxable events included in Article 4th Articles, which states that it is income obtained by the taxpayer, whatever its source or origin. The estimates of income and concept of economic activity and assets, according to the 5th Article of General Tax Law, economic activity and an independent management of the means of production and human resources, or one or of the two, with the aim of being involved in the production of and distribution of goods. If the activity is property leaves, economic activity will be considered only when there is at least one person employed with a full-time work contract. If there is a set of entities that are part of the group of the economic activity will be determined to take in place all those that form part of it. or taking into account rather. Yeah. When more than half of the assets of a company consists of securities or it is not affected by an economic activity, it will be considered a patrimonial entity. They would be companies that main activity consists of managing fiscal and property assets, which does not carry out any economic activity itself. Now we have income allocation. Although corporate tax was defined as a tax that taxes the profits of a company, some entities are exempted even though an income has been attributed to them. In these cases, taxation is subject to IRPD, personal income tax. In the 6th article of the General Tax Law, states that that's called GTL, it may come up later, states that the income corresponding to civil societies, entities that are not considered taxpayers of this tax, states, joint property entities, and other entities mentioned in Article 35 of the GTL, as well as withholdings and income on accounts that they have borne, they will be attributed to the partners, heirs, co-owners, and participants respectively. The entities under the regime of income allocations will not be taxed by the corporate tax. Now we come to the taxpayers. As Article 7 of the GTL, General Tax Law, states that the taxpayers are those who are domiciled in Spanish territory and who have a legal personality, except civil companies that have no commercial purpose. Within the taxation made by the GTL on taxpayers, there are entities that, despite not having legal personality, are taxed by companies. Let me tell you some of these. And these entities are investment funds, temporary union of companies, venture capital, pension funds. Okay. Investment funds, they were established by this law. The temporary unions are a tax regime of groups and temporary unions of companies and regional industrial development companies. Venture capital funds and closed-type collective investments. Here we are, pension funds, regulated by a certain law for the pension plans. Okay. The regulation funds of a mortgage market, regulated by the mortgage market. Mortgage securitization funds. A regime of companies and real estate investments on mortgage-backed securities. The asset securitization funds refers to the additional provision of the law on the adoption of the Spanish legislation governing credit of the Second Banking Coordination Directive and other amendments much related to the financial system. To move on, the investment guarantee funds, the Joint Committee of Owners Fund, just as a regime of communal lands or its corresponding autonomous legislation, and the Bank Assets Fund, construction and resolution of credit institutions. Residents of the taxpayer residing in the national territory while residing in it involves paying tax. Entities that meet any of the following requirements will be considered a resident and therefore shall pay tax. Established according to laws of Spanish laws, their registered office is in Spanish territory. Their effective management headquarters are in Spanish territory. An entity will be considered to have its effective management headquarters in Spanish territory when the management and control of its activities is in it. So, to avoid tax fraud, Article 8.1, the corporate tax stipulates that the tax administration may presume that an entity located in a country or a non-tax area, in Section 2, the first additional law, has its residence in Spanish territory where its main assets, directly or indirectly, consist of assets located in Spanish territory or rights that are fulfilled or exercised in Spanish territory, or when the main activity is carried out in it, unless the entity certifies that its effective management takes place outside of the country. So, as well as that establishment and operation of the entity is justified for valid economic reasons or substantive business reasons other than the management of securities or other assets. And that is to say, even if the headquarters of the organization are in a taxation or in a no-tax country, its residence will be assumed to be in Spanish territory to make it pay its taxes, unless it proves that all its activities are carried out from the other place. All the income obtained by non-resident entities will be taxed by the non-resident income tax. Now we have tax residence. What was it first we were doing there a few seconds ago? A resident or taxpayer. Now we're doing a tax residence. This is by a different article. It states that the tax residence of the taxpayer resident within a Spanish community will be a resident of the registered office, providing their administration and business management is effectively centralized in the registered office. In other words, the place where management is carried out will be considered. According to the above criteria, if for whatever reason locations of tax residence cannot be established, tax residences will be the highest value of the fixed asset. The registered office is established by the bylaws of the company. Now we come to changing a tax residence. When a company changes its tax residence, taxpayers must inform the Spanish law tax agency. Spanish tax agency may promote the change of tax residence after hearing the interested party in a manner determined by the regulation. Now we come to exemptions. As seen before, the exemptions are given when there is no tax obligation, even though the taxpayer carries out the taxable event. Exemptions are therefore a tax benefit. Exemptions can be subjective, totally or partially, or objective. In the latter, Articles 21 and 22 should be highlighted where exemptions to avoid double taxation appear. This part will be later discussed. The most important points regarding subjective exemptions are explained in the following. Here are the articles following are totally exempt from taxes. the state itself, the autonomous communities and local entities, the autonomous bodies of the state, and the entities of public law of similar character of the autonomous communities and local entities, the Bank of Spain, the deposit guarantee funds of credit unions, and the investment guarantee funds, managing bodies and the common services of the Social Security, the Institute of Spain and its Royal Academies, and the institution of the autonomous communities with their own official language that have purpose similar to those of the Royal Spanish Academy. The rest of the public bodies, as well as the similar entities of the public law of the autonomous communities and local entities. Now, some tax bodies refer to this section as the Spanish Tax Agency, the Economic and Social Council, and Cervantes Institute. Oh, these are some of the bodies referred to in this section: the National Security Market Commission, the Nuclear Safety Council, the Public Administration of Universities, the Data Protection Agency, the Consortium of the Canary Islands Special Zone, Spanish Entity Energy Commission, and the Telecommunications Market Commission. The state laws included in the first, second, and third additional provisions of the law. The International Public Oversight Boards in auditing standards, professional ethics, and related matters. Partially exempt entities include the following: non-profit entities and institutions not included in the previous section, unions, federations, and confederations of coordinates, the professional associations, business associations, official chambers, and labor unions, and employment promotion funds constituted under the law on reconversion and reindustrialization. And that ends page 16. We've been doing international corporate tax, and we were just going through partial exemptions, certain things as nonprofits, unions, professional associations, employment promotion funds, and so on. And now we're coming to the new page, page 17. Other ones, nonprofit employee associations, which collaborate with the Social Security Agency, public law entities, ports of state, and port authorities, and political parties. Tax base and tax reassessments. Well, the tax base, as set out in Article 10 of the corporate tax law, is constituted by the amount of income obtained in a tax period reduced by the negative tax base offset of previous tax periods. And the tax base is determined by the general direction estimation method, or the objective estimation method, when the law determines its application, or the indirect estimation method. And the direct method, the tax base will be calculated by correcting and applying the precepts established by the laws to the accounting results. It determined in accordance with the regulations of the Code of Commerce, and in other words, other laws related to this determination, and in the provisions that are dictated in the development of the mentioned regulations. In the objective estimation method, the tax base can be determined totally or partially by applying the signs, indexes, and modules to the activity sector determined by the corporate tax law. And in the case of indirect estimation, it is an extraordinary power of the tax administration, and it applies, for example, to companies that have not made the declaration, and so there is no way to know their real data. The next step is to determine the accounting profit, which is determined by the following regulations: Code of Conduct, Spanish Corporation Law, Limited Liability Company Act, Spanish Auditing Act, Spanish National Chart of Accounts, Audit Regulations, Ministerial Orders proposed by the Spanish Accounting and Account Auditing Institute. Corporate tax is established as follows: plus or minus the accounting and profits and the accounting adjustments, and it equals a prior tax base. Don't forget that comes into it. And subtractions are the capital reserves and the compensation for a negative tax base incurred in the previous year. And multiply by whatever the tax rate is that's left, and that gives you your gross tax charge. And now you have certain deductions to declare certain allowances, and that is a positive adjusted gross tax charge. Correct. Now we have other deductions to encourage certain activities such as research, and also other things for installment payments, retention, and account income. The corporate tax law also includes adjustments that can be carried out to obtain the accounting profit, so-called non-accounting adjustments. They are certain adjustments such as expenses, valuations, provisions, and amortizations, which modify the tax base and consequently produce a positive or negative adjustment in the taxpayer. If these adjustments do not modify the tax base, the taxpayer should not make any adjustments. And the following sections will be discussed. We'll discuss these corrections in quite a bit of detail. Let's have a look first of all at amortization. So they take into account in the process of depreciation of the elements of the fixed or non-fixed assets of the company, depending on its useful life. Machines will break down, cars need to be replaced, they get old. They are part of the expenditure items to establish the accounting and tax results of the company and provide the funds that allows financial recovery of the investments made in the elements which are going to be amortized or die, really. In this way, corporate tax law establishes the depreciation to be real and effective as it is an essential condition for its deductibility. This depreciation will be observed following one of the methods listed in Article 12. The article that in the concept of the depreciation of tangible assets and amortization of intangible assets and real estate investments corresponds to the effective depreciation undergone by the different elements due to operation, use, enjoyment, or obsolescence. Obsolescence is a big one, especially in the age of IT, will be deductible. The depreciation will be considered effective when it is a result of applying straight-line amortization coefficients established in the officially approved amortization schedule. Now, here we have the type of elements, the maximum straight line coefficient for certain items, and a maximum period of depreciation. By the way, yes, okay, so if you see if it's land, you can drop it by 6, infrastructure, mining, that sort of thing. And you can do that for 30 years rather. Now you have other things like plants, and they will be depreciated using these figures. Buildings, industrial buildings, for example. All right, let's have a look and see if there's anything else. Should be more, actually. Dumping sites, yes, because of course they're going to get full. Warehouses and deposits, gaseous, liquid, and solid. Commercial, administrative, service, and housing buildings. Yeah, we're going to be going down. Substations, energy transmission and distribution grids, cables. They're going to have to be replaced from time to time. Other insulation, machinery, medical equipment. Yes. Now we come to transport. Now we go. There we go. Locomotives, wagons, and traction systems, vessels, and aircraft. That is surprising. It's only 10%. The elements of internal transport, the elements of external transport, and freight transport. Now we come to furniture and appliances. Yeah, go down by 10%. In reality, of course, it's much greater than that. Let's have a look at some other things. Now there you are. Glassware, yes, very much so. 50% linen, 25 tools, molds and dyes. Now we come to electronic equipment, data processing equipment. Yeah, they're considered pretty much. There you go. There's a good one. 33% for computer systems, film production, phonographs, videos. Again, 33%, and then that might be a blanket result for other things. Here's also applying a constant percentage of the brought forward net value. And in this case, the taxpayer will select a period to amortize the asset, provided that the upper limit is set by the amortization table. As you know, it says a certain number of years, and the lower limit is the time in which the asset will be amortized in case of applying the maximum coefficient that the table indicates. Yes. So, if I may explain, this 33%, right, well, you couldn't really be knocking that off for 6 years, so they have to take that. So I do believe this is implying that somehow there's a little bit of discretion being involved here. Yeah. Okay. Anyway, let's go on forward with that. Anyway, so we're optimized after the step. Straight line depreciation coefficient is determined by dividing the. We better go over this again. And the lower limit is the time in which the asset will be amortized in the case of applying the maximum coefficient that the table indicates. And after this step, the straight line depreciation coefficient is determined by dividing the chosen years by 100. The constant percentage will be determined by weighting the straight line depreciation coefficients attained from the amortization period according to the officially approved amortization schedules, and it will use the following coefficients. But just before we go over that, I'd just like to slick back up here just for a few seconds. Oh, straight line. I'm actually personally wondering if it's, I'm thinking this is straight line, and when we say straight line, I think it's not like a never-ending bubble. I'm pretty sure this would mean that after 4 years, you're done. Not 100% sure of that, but I think so. Because what does straight line mean otherwise? Anyway, clarification. I could have really asked that question. Anyway, let's get on with the coefficients. Okay. 1.5 if the element is amortization period less than 5 years. And so 1.5 and 2 is if the element is amortized equally or higher than 5 but lower than 8, and 2.5, and the constant percentage cannot be lower than 11%. Property, plants, and equipment will not be eligible for depreciation by constant percentages. It is a result of applying the sum of the digits method. Sum of the digits will be determined based on the amortization periods established in the officially approved amortization schedules. Property, plants, and equipment will not be eligible for depreciation by digit numbers. It is adjusted to a plan formulated by the taxpayer and accepted by the tax administration, and the taxpayer justifies the amount. Amortization and revalued assets, plants and equipment, intangible assets, and real estate investments. The accounting principle applied to taxation are entirely mandatory for the amortization period tied out fiscally to be effective. Tangible assets owned by the company that are engaged in productive activity over a certain period of time are considered property, plant, and equipment. Fixed assets are the assets that are intended to serve the activities of the company and costs of establishment and distribution of a long-term basis. Residual value is the value that is expected to be recovered for the asset once it has been completed its life cycle and it's out of service. Intangible fixed assets are the ownership of certain rights or certain products, production systems, which are not tangible, but allow the productive process to be carried out for several years. A good example of that would be a patent. An intangible fixed asset are permanent intangible assets constituted by rights capable of economic assessment. Common standards included in Article 3 of the corporate tax regulations are as follows. The acquisition price or production cost will be amortized, excluding, if applicable, the residual value in the case of buildings, the part of the acquisition price corresponding to the value of the land, excluding, where appropriate, the cost of rehabilitation, and it shall not be amortized. When the value of the land is known, it will be calculated by prorating the acquisition price by the land and construction land values of the year of the acquisition. However, the taxpayer may use a different distribution price criteria when it is proven that these criteria are based on the normal land and construction value of market of the year of acquisition. Amortization will be carried out on all elements. In the case of similar assets or assets that are similarly used, amortization may be applied to all of them, provided that the accumulated amortization part corresponding to each asset can be known at any time. Technical installations may be a single element subject to amortization. Technical units will be considered complex units of specialized use in the production process that include buildings, machinery, material, pieces, and elements, including computer systems that, despite being separable, are linked definitely for their operation and are amortized at the same rate, as well as the spare parts or replacements valid exclusively for the type of installation. The elements of equity from tangible and intangible fixed assets and real estate investments will begin to be amortized from their startup, and the intangible assets from the moment they are able to produce income. Property, plant, and equipment assets and real estate investments must be amortized over a period of their useful life, which is considered to be the period in which, according to the amortization method adopted, their value must be fully recovered, excluding the residual value unless the period exceeds the concession period. In the case of assets subject to reversion, where the maximum annual limit will be calculated according to this last period, the costs related to major repairs will be amortized during the period that lasts until the repair. In the case of intangible fixed assets, their useful life will be the period during which they are expected, within reason, to produce some income. I think this could be how useful is a new method of production until it's copied by so many other places that it's no longer innovative. Yeah, and that could be a pretty short number these days. Anyway, intangible fixed assets will be amortized based on their useful life. When their useful life cannot be estimated reliability, the amortization will be deductible with the maximum annual limit of 1/20th of its amount. That's interesting, because that isn't really very reasonable for computer stuff. It might be reasonable for, other things that have a longer lifespan. However, different amortization periods cannot be applied simultaneously or successively in the same asset. However, in exceptional cases, established and justified in the annual accounts, an amortization method different from the method that was applied may be applied in a new situation. When the renovations, additions, or improvements to the tangible fixed assets and real estate investments are included in the aforementioned assets, their amount will be amortized during the remaining tax period to complete the useful life of the aforementioned assets. And to this end, each tax period will be charged to the result of applying to the amount of the renovation, extension, or improvements the coefficient resulting from dividing the posted depreciation of the asset in each tax period to the extent that corresponds to the effective depreciation by the book value that this asset has had at the beginning of the tax period in which the renovation, expansion, or improvement operations were carried out. The assets that were renovated, expanded, or improved will continue to be amortized according to the method that has been applied prior to the realization of the renovation, expansion, or improvement. And when the operations mentioned in this section determine a lengthening of the estimated useful life of the asset, it must be taken into account for the purpose of amortization of the assets and the amount of the renewal, extension, or improvement. Number 7, when the regulations of the previous section will also apply in a case of accounting revaluations made under legal and regulatory standards that require including their amount in the accounting results. And number 8, in case of mergers, total or partial division and contribution to the amortization method to which each acquired asset was subject should be continued, unless the taxpayer prefers to apply their own amortization method to them, and in this case they should formulate an amortization plan. These standards regarding the amortization of the elements updated in accordance with the provision of the law of regularization and updating will continue to be applied, and will continue to be applied. Updated in accordance with the provision will continue to be applicable until the end of their useful life. In other words, acquisition minus residual value is depreciable value. Well, I could have told you that one. Amortization according to the amortization tables. When the taxpayer chooses the amortization method according to amortization tables, the depreciation will be effective when it is the result of applying any of the following coefficients to the acquisition price or production cost of the fixed asset. The maximum straight-line depreciation coefficient established in the officially approved amortization table, coefficient of straight-line amortization that derives from the maximum amortization period established in the amortization table, officially approved, and any other coefficient of straight-line amortization comprised between the two previously mentioned methods. Now, for example, if we want to amortize the acquisition of licenses for all computers in our organization for a value of $12,500, following the straight line method, we will do the following. The table, the maximum coefficient is 33% for 6 years, so we will calculate 33% of 4,125. I really want to know, but I'm thinking that means it's done in 3 years. There are two options in the applications table, but I would really like to check out on the straight line. Yeah, so I just looked it up, and my understanding was correct. So if you use 44,125, you keep using 4,125. It's not 33% of what's left is 33% of the original amount. Yeah, okay. And so therefore, um, if, and I'm imagining or trying to think that maybe they're assuming that you might, why would they say 6 years? If it's 33% a year, there's no way you can be able to do that for 6 years because it'll be gone. Yeah, anyway. Oh, on we go, on we go. Amortization of assets used in more than one daily shift. Oh, that's interesting. In special cases, deals with the use of fixed assets in more than one daily work shift. The amortization. So, the amortization of assets used in more than, this is part 3 of International Corporate Tax, Module 2. Amortization of assets used in more than one daily shift. And this special case deals with the use of fixed assets in more than one daily shift. The amortization coefficient will be the result of the sum of the coefficient of straight line amortization that derives from the maximum amortization period, and then the result of multiplying the difference between the maximum straight line depreciation coefficient and the straight line depreciation coefficient that is derived from the maximum depreciation period by the quotient between the daily hours used in the work and 8 hours, which is considered to be a normal day. Well, if I understand that correctly, quotient. Yes. Yeah, in other words, if you use it for 16 hours a day, you can wear through this stuff a little bit earlier. It's as simple as that, really. Even triple it. If you use your computers 24 hours, I imagine with 33%, you could, if I understand this correctly, you'd be able to wipe them off in 1 year. Anyway, thanks to the amortization, which is funny because that is not one of the things that happens. Yes, computers get old and they get outmoded, and you definitely need to replace them. But even if they were being used 24 hours a day, they really are, yeah, that's kind of a little sweet place there. Thanks to the amortization tables, the minimum period of the maximizing amortization coefficient is obtained. The minimum coefficient is deduced from the maximum time period. In the amortization method, according to the officially approved amortization tables, the useful life cannot exceed the maximum amortization period established therein. Right, I agree with that. The provision of this section shall not apply to those elements that should be used continuously due to their technical nature. Oh. All right, amortization of used acquired assets. In the case of tangible fixed assets and the real estate investments that are used when acquired, that is, that do not operate for the first time, the calculation of the amortization will be made according to the following criteria. A, the basis of acquisition price upon the limit resulting from multiplying by 2 the amount derived from applying the maximum straight line amortization coefficient. Or if the acquisition price or original production cost is known, it can be taken as a basis to apply the maximum straight line amortization period. If the acquisition price for original product is not known, the taxpayer may determine it by expert appraisal. Once it has been established, the provisions of the previous letter shall apply. If the acquisition of used assets is made within entities belonging to this same group of companies in the sense of criterion established by Article 42 of the Code of Commerce, the amortization will be calculated in accordance with the provisions of paragraph B. Unless the acquisition price was higher than the original price, in which case the deductible amortization will have a limit. The result will have as a limit the result of applying the maximum straight line amortization coefficient to the acquisition price, which, notice, could be higher. For the purpose of this section, buildings less than 10 years old shall not be considered as used assets. Oh, very important. Amortization according to constant percentage. Okay, when taxpayer chooses this method, the depreciation will be effective when it is a result of applying a constant percentage of the value pending amortization of the asset that will be determined by weighting any of the coefficients referred to in Section 1 of Article 12 in the following way. 1.5 if the asset has an amortization period of less than 5 years. 2 if the asset has an amortization period equal to or higher than 5 years, but lower than 8. And 2.5 if the asset has an amortization period equal or higher than 8 years. For the purpose of the provision of the previous paragraph, the amortization period shall be understood as the period corresponding to the chosen straight line amortization coefficient, and in no case may the constant percentage be less than 11%. The amount pending amortization in the tax period in which the useful life ends will be amortized in this tax period. For example, we want to amortize the electronic equipment in an organization. Its value is $150,000. The maximum depreciation coefficient is 20, and its maximum amortization period is 10. We use 5 years to. It is a case of choosing 5. Good, choosing. Yes. So we have to calculate it if the period we want is within the margins. As limit 10, lower limit 5, 10 divided by 5. As we are within the limit, it is now necessary to calculate the coefficient by which we will ponder. That is to say, 100 by the number of selected years. 100 divided by 5 is 20%. Boom. The weighting of between 5 and 8 years will be applied. That is to say, 2. And the amortization coefficient will be 40. Property, plants, and equipment cannot be amortized by the depreciation method according to the constant percentages. The use acquired assets can be amortized using the constant percentage amortization method by applying the constant percentage referred to in sections A, B, and C. D, the sum of the year's digits depreciation method. When the taxpayer chooses the sum of the year's depreciation method, depreciation will be effective when the depreciation installment is obtained by applying the following methods. Sum of the digits will be obtained by adding the numerical values assigned to the years in which the asset is to be amortized, and for these purposes, the highest numerical value of the years in which the asset must be amortized is assigned to the year in which the amortization must begin. And for the following years, numerical values are successfully decreasing by 1 unit until reaching the last value considered for amortization, which will have a numerical value equal to the unit. The assignment of numerical values may also be done conversely to that provided to the previous paragraph. The amortization period may be any of those included between the maximum period and the period dedicated to maximum straight-line depreciation coefficients according to the officially approved amortization tables. B, the purchase price of the production cost will be divided among the sum of the digits obtained according to the previous paragraph, thus determining the quota per digit. Under C, the quote per digit will be multiplied by the numerical value corresponding to the tax year. Now they're going to give you an example. For example, we want to use the sum of the digits year appreciation to amortize the purchase of automatic forklifts using the internal transport of our company priced at $80,000. The maximum straight line depreciation is 10%. Aha. The maximum amortization period is 20 years. Now, on the basis of this, we use the minimum of the tables. 10 divided by 10 is 10 years. Okay. And years of amortization, we calculate the sum of the digits. Oh, they really do mean some of the digits. Ho ho, ho ho. Yeah, or 1 plus 2 plus 3. Ah, yes, yes, yes. Of course, of course. I couldn't even believe it, but this is so mathematical. Anyway, it happens to be 55. Finally, we calculate 80,000 divided by 55, which is 14. Yeah, there you go. There you go. The file of amortization can be deducted based on that, and it will as follows. Whoops, 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 whoops. Isn't that clever? Yes. Isn't that clever? So you, in other words, instead of doing a constant amount, isn't that something? Somebody's put a lot of thought into this. Yeah. I have a gut feeling that it's going to actually work out, but anyway. Oh yeah, oh yeah. 3, 4, yeah, yeah. So yeah, what is basically, yeah, it's kind of cool. I would really like to look at it. Yeah. Oh, of course it's going to work out because if there's 55 units, yes, of course it works out because segmentally, you're taking a fraction of the whole thing and you're taking 10 out the first year and 9 out and then 8 and then 7. Of course it's going to work out exactly to the value of the forklift. Oh my goodness, yes indeed. Understood. Property, plants, and equipment cannot be amortized using this method. Amortization schedules. Taxpayers may propose a tax agency a plan for the amortization of tangible fixed assets, tangible assets, or real estate investments. The request must include the following information: the description of the assets, special amortization indicating the activity in which they are assigned, the amortization method that is proposed, indicating the temporary distribution of the amount amortization derived, justification of the proposed amortization method, acquisition price or production cost of the asset, and date at which the amortization of the assets must begin. In the case of assets under construction, the expected date on which the amortization should begin shall be indicated. The tax agency must collect all the data, reports, background, and supporting documents that may be necessary from the taxpayer. The taxpayer will be noted in the instructions of the procedures before writing the proposed resolutions on file. In this way, the taxpayer will have up to 15 days to formulate all the allegations and submit all the documents and justifications that they may consider appropriate. And the resolution that ends the procedure may be to approve the amortization schedule made by the taxpayer, approve an alternative amortization made by the taxpayer in the course of the procedure, or dismiss the amortization schedule made by the taxpayer altogether. The procedure must be completed within 3 months from the date on which the application is registered in any of the registries of the competent administrative authority, or from the date of forest correction at the request of this body. These approved amortization schedules can be applied to other assets that have the same character and whose amortization will begin before 3 years from the date of notification of the approval agreement of the amortization schedule. The only condition is to maintain the physical, technical, optical, legal, and economic circumstances that determine the amortization method that has been approved. Amortization justified by a specific case. Now, the taxpayer can also consider amortization as an expense, provided that the effective depreciation is truly justified through reliable proofs. Now we have a free amortization. The corporate law only allows free amortization in certain cases, including in Article 12, and these are the cases: property, plant, and equipment, tangible assets, and real estate investments of labor corporations and limited labor companies assigned to the performance of their activities acquired in a 5-year period from the date of their classification as such. Tangible and intangible assets, excluding businesses affected by research and development activities, buildings can be amortized linearly over the 10-year period insofar as that they are earmarked for research and development activities. C. The research and development expenses activated as intangible assets, excluding depreciation of time. Items have a freedom of amortization. Tangible or intangible assets of the entities that are qualified as priority associated operations in accordance with the provisions of Law 19 of the 4th of July on the modernization of agricultural holdings acquired during the first 5 years from the date of its recognition as priority exploration. Any new tangible fixed assets whose units value does not exceed £300 up to the limit of €20,000, referred to as taxable period. If the tax period lasts less than 1 year, the limit indicated will be the result of multiplying €25,000 by the existing proportion between the duration of the tax period with respect to the year. Amortization on leased assets. Article 106 of the Corporate Tax Law established a special tax regime more beneficial for those leasing contracts that meet certain requirements. Contracts that meet the following requirements may be benefit from more beneficial taxation. The landlord must be a credit institution or financial institution. Established financial credit establishment. This exclusive purpose must be the assignment of the use of movable or immovable property, and the lessee must be used the leased asset exclusively for their business or their professional activity. Their minimum duration must be 2 years in movable property and 10 years in real estate and industrial establishments. So, the consideration of the use of the property must be expressed in the contract. It should differentiate the part corresponding to the cost of recovery of the transferred property and the part of financial burden. In addition, the annual part of the cost recovery of the asset must be constant or increase over the contractual period. The contract must also include a purchase option in favor of the tenant. For those contracts that meet all of the above requirements, the following must be differentiated. The financial burden, which will be the tax deductible in any case, and will not be conditioned to its accounting allocation in the profit and loss account. Therefore, there is no difference between the accounting and the tax policy. So there is no need to make any kind of accounting adjustment. B. The part of the installments that correspond to the cost recovery of the goods is also deductible, but it has a maximum limit. The result is applying twice the maximum straight line coefficient of the table that corresponds to it. Okay. In addition, the excesses that could not be deducted in a taxable year may be deducted in the following years. Respecting the same limit, twice the maximum coefficient as an exception to the general rule that requires an expense to be booked so that it can be deducted fiscally for its deduction. This maximum amount does not need to be booked, which will lead to negative adjustments during the first years and positive adjustments after. The limit of small-sized companies is not twice, but 3 times the maximum depreciation pursuant to the table, since double of the straight-line rates for the depreciation will be taken pursuant to amortization tables officially approved, multiplied by 1.5. Provisions and adjustments. The provisions of the accounting expression of impairment, loss, or lasting depreciation of an asset that is considered reversible. There are several types of provisions. Provisions of the asset, which include or reflect a reversible impairment loss experienced by the active assets of the entity. The provision of liabilities and charges, which cover the expenses caused by an exercise or cover the loss or debts as regarded their nature, but the indeterminate as a result to the exact amount or date in which they occur. The corporate tax establishes that a provision that is entered into by accounts may not be a tax-deductible expense. In addition, if the provision is not entered into the account, it cannot be deductible expense just because it does not appear in accounting. Categories of foreseeable expenses. Well, actually, A, actual expenses, but with an undetermined exact amount. B, likely expenses, or determined or of an undetermined or determined amount. And C, foreseeable or undetermined expenses regarding the date at which they were to occur. Article 13 of the Corporate Tax Law states that the loss of depreciation of credit derived from the risk of debtor insolvencies will be deductible when, at the moment of accrual of the tax, any of the following circumstances occur. A, the 6-month period from the maturity of the bond has elapsed. B, the debtor is declared in a situation of bankruptcy procedures. C, the debtor is prosecuted for the crime of asset stripping. D, the obligations have been claimed judicially or are subject to a judicial litigation or arbitration proceedings whose solutions depend on collection. Now, the following loss of depreciation of credit will not be deductible. Losses corresponding to credits owed to public law entities unless they are subject to the arbitration or judicial proceedings that look at their existence or amount. Another one of those is a loss corresponding to credits owed by linked persons or entities unless they are in a situation of bankruptcy proceeding and liquidation phase has been opened by the judge under the terms established by the law, or a loss corresponding to global estimates of the risk of insolvency of customers and debtors. The corporate tax law establishes the expenses for provision and internal funds for the coverage of internal and analogous contingencies to those that are subject to the revised tax of law of regulation of pension plans and funds approved by the legislative royal decree and will not be deductible. These expenses will be tax deductible in the tax period in which the benefits are paid. Expenses associated with provision derived from implicit or implied obligation will not be deductible. The corporate tax law also establishes a non-deductible provision expense, those related to long-term compensation to personnel through defined contribution schemes, with the exception of the pension plan regulated by RDL of the amended text of the acting governor, pension plans and funds, and those made to corporate social security plans. Those related to costs of compliance with contracts that exceed the economic benefit that are expected to be received from them. Those derived from restructuring except legal and contractual obligations and not merely tacit. Or D, those related to risk of sales returns, and those DE, those are personnel that correspond to with payments based on equity instruments used as compensation for employees. Assets may also be lost value due to impairment. Impairment loss is the accounting expression for the value judgment generated by the losses due to the impairment of the asset, whether current or not. Corporate tax law is a fairly restrictive law regarding the deductibility of impairment losses, as will be seen below. But the following will not be deductible: impairment losses of fixed assets, investment property, and intangible assets, including goodwill. Impairment loss of the securities representing the participation in the capital or the entity equity. C, the impairment loss of debt securities. Impairment loss in this section will be deductible in these terms established by Article 20 of this law. Finally, contributions of companies to pension plans can be deducted. They can be classified as two types: pension plans comprised with internal functions and pension plans comprised with external functions. Plans comprised of internal functions are plans created by the company by creating a fund through contributions of period provisions. This type of plan is not deductible at the time of provision, as regulated by Article 14 of the corporate tax law. However, the corporate tax law emphasizes that when a worker generates the right to receive a payment from a fund, the amount paid to the worker may be deducted. Plans followed by external funds are plans in which the company contracts a pension plan with an external company that manages it. The company contributes an amount periodically to it, and in this case, the plans are deductible. Non-deductible expenditures and valuations of the assets. Deductible expenses are all those expenses included during the financial year that appears in the profit and loss column accounts. They must have proof as the expense and be charged in the accounting year. They must be justified by document and invoice and must support a real operation. Despite having expenses that meet the above requirements, Article 15 of the corporate tax law also includes certain expenses that cannot be deductible. Here are some examples. The following will not be considered tax-deductible expenses. A, those that represent a payment from the equity. The following can be found among these: dividends and premiums for attending general shareholders meetings, reserved distributions among shareholders, profit participation not related to the remuneration of personal services, amounts distributed between corporate members to the benefit accounts, and returns to members of the mutual insurance. Now, according to the corporate tax law, representative equity securities or securities representing the funds for entities, whatever their accounting classification, are considered payment from the equity. In addition, participatory loan granted by entities that are part of the same group of companies, according to the criteria established in Article 42 of the Code of Commerce, regarding regardless of the residence and the obligation to file consolidated financial statements, are considered payment from the equity. International Corporate Tax, Part 4, Lesson 2, Module 2, Part 4. 2.1.5, non-deductible expenditures and valuations. Deductible expenditures are all the expenses incurred in the financial year that appear profit or loss. They must have proof as an expense and be charged in the accounting year. Despite having expenses that meet above requirements, Article 15 of the corporate tax law includes certain expenses that cannot be deductible. The following will not be considered tax-deductible expenses: those that represent a payment from the equity. The following can be found among dividends and premiums of attending general shareholders, reserved distributions among shareholders, profit participation not related to the remuneration of personal services, amounts distributed between cooperative members to the benefit accounts, returns to members of mutual insurance companies. Okay, that being said, let us put a pause. We've already covered that. So, Part B, derivatives from the accounting of the corporate tax. Those coming from this account will not be considered as income. In that case, the accounting result should be increased by the corresponding tax rate. to obtain the tax base. C. Criminal or administrative fines and penalties, surcharges for the late payment of taxes. Yeah, you can't receive, they call these deductions and surcharges for extemporaneous declarations without prior request. For example, our company has an accounting result of 20,000 euros. We received a 5,000 euro sanction. As the sanction is not a deductible expense, we will have to record the penalty as an expense in our accounting. So we will have to make a positive accounting adjustment for the amount of the sanction, obtaining the accounting result of 25,000 euros. Losses from gambling. Wow. Free gifts, except gifts for certain entities, foundations of assets registered. Yes, registered gifts of assets for cultural interest, assets aimed at contributing to the conservation of assets of cultural interest and the performance of activities of general interest up to a limit of 10% of the tax base, and the first case 30% of the tax base. Expenses derived from actions contrary to the Spanish legal order. Of course, they can't be deducted. Expenses for services corresponding to operations carried out directly or indirectly with a person or entities resident in countries or territories considered tax havens, or that paid through persons or entities resident therein, unless the taxpayer proves that the accrued expense responds to an operation or transaction that was actually performed. The regulation of international fiscal transparency will not be applied to the income corresponding to expenses classified as non-tax deductible. And then again, another one, financial expenses accrued in the tax period arising from tax with entities and groups according to the criteria established in Article 42 of the Code of Commerce, regardless of residence or the obligation to file consolidated financial statements intended for acquisition or other entities of the group, capital, shareholding, or equity of any type or description. And yeah, got a long way to go. We're only on page 33 of quite a few pages. Okay, and other entities and groups, capital, shareholding, and equity of any type of entity, or to make contributions in the capital or equity of other entities in the company, unless the taxpayer proves that there is a valid economic reason for the performance of such things. By the way, I do hope that the question section has got more than 10 questions in it. This is just rather embarrassing otherwise. Expenses derived from the termination of a common or special employment relationship or a business relationship referred to in Article 17 of 28th, November 28th, or personal income tax and partial modification of corporate tax law on the non-resident income tax or property tax or both, or even if they are satisfied in several tax periods, which exceeds for each beneficiary the largest of the following amounts: 1 million euros, or the amount established as mandatory in the Statute of Workers' Rights in its implementation regulation, or as in the case may be in the Execution Sentences Act, without being considered as such an established under an agreement or contract. However, in cases of collective dismissal carried on in accordance with the provisions of Article 51 in the Statute of Workers' Rights, or as a result of causes included in the letter C, and the aforementioned statute, provided that in both cases are due to economic, technical, organizational, production, or force majeure. I knew we came to that, and will be the amount established with mandatory in the statute for unfair dismissal. For these purposes, the amount paid to other entities that are part of the same group of companies and in which the circumstances included in Article 42 or the Code of Commerce are met with will be included, regardless of their residence, and obligations to file consolidated financial statements. Such shall be computed. Expenses corresponding to operations performed with related persons or entities that, as a result of different fiscal qualifications in these, do not generate income or generate an exempt income, or the one that is subject to the nominal tax rate of less than 10%. An explanation of assets and their value can be followed below. A general valuation rule. Assets will be valued in accordance with the criteria established in the Code of Commerce, although they will be corrected by the application of the principles established in the corporate tax law. However, variations in value arising from the application of fair value basis will not have an effect on the tax purposes unless they have to be charged to the profit and loss account. The amount of accounting revaluations will not be included in the tax base except where they are carried out under laws and regulations that state that it is compulsory to include that amount in the profit and loss statement. The amount of the revaluation not included in the tax base will not determine the higher value of the revalued items for tax purposes. Capital or equity increase through credit compensation will be valued fiscally by the amount of this increase in a commercial manner, regardless of the accounting valuation, or is as established in Article 17. And for example, our company acquires premises worth 200,000 euros. The same place is valued by the community of Murcia as a value of 208,000 5 years later. Taking into account that the acquisition costs were 30,000 when selling the premises this year, the acquisition value to calculate, profit from the sale will be 200,000 plus 300, which is 230,000. Okay. Voluntary accounting revaluation. Anyway, voluntary accounting revaluation. Article 17 of the corporate tax law establishes that unless revaluation is mandatory under the legal standards, the amount of accounting revaluations or positive difference in the value accounting for the social entities will not be included in the tax base. Valuation of certain operations. Assets, objects of the operation that are included in the regulation will be valued by their market value as established by the corporate tax law. The market value is defined as the value agreed on in normal market conditions between independent parties. Market value will be discussed later. Article 17 includes the following assets subject to the normal market evaluation. A, lucrative transferred or acquired assets. Subsidies do not have this consideration. A transfer entity will integrate in its taxable base the difference between the market value of the transferred asset and its tax value. The transferee entity, in turn, will integrate into its tax base the market value of the acquired assets. In Part B, assets contributed to equity entities and the values received as consideration. C, assets transferred to partners due to dissolution, withdrawal, or the shareholders' capital reduction with the funds returned to the partners, distribution of share premiums, and distribution of benefits. 4, assets transferred as a result of a merger, absorption, or full or partial spin-off. As in case of point A and cases B, C, and D, the transferring entity will also integrate the difference between the market value of the transferred assets and its tax value in its tax base. E, assets acquired in the exchange of asset transactions, and in this case, if the market value of the acquired asset is less than the book value of the transferred asset, the swap results in a loss that must be computed. And F, assets acquired as a result of exchange or conversions. Now, when a company modifies its residence, provisions of Article 19 will apply in reference to changes of residence. The difference between the normal market value and the tax value of the assets it has been transferred outside Spanish territory. Unless they remain within the territory, they will be included in the tax base, and in this case of affectation to a permanent establishment, the provisions of Article 78 will be applied to these assets. Transactions carried out with persons or entities resident in countries or territories classified as tax havens will be valued at their market value. Regarding the valuation of the amounts subject to withholding, the recipient of the amounts over which the recipient must withhold his tax shall compute them for the full consideration accrued. When the withholding has not been made or would have been made for an amount lower than due for reasons attributable exclusively to the retainer, the recipient shall deduct the amount that should have been withheld from the fee. And in the case of legally established payments that have been made by the public sector, the recipient may only deduct the amounts actually withheld. When the full consideration accrued cannot be proved, the tax agency may compute the gross tax charge as an amount after subtracting the appropriate withholdings, yet the actual receipt, and in this case the difference between what is actually received and the gross tax charge will be deducted from the fee as withholding tax as stated in Article 19. Now, for example, our organization receives 20,000 euros in interest from a loan whose tax rate is 10%. Interest corresponds to the consideration, and 10% will be deducted from the 20,000 as withholding on the amount received. 20,000 times 10 is, of course, 2,000. The interest does not correspond to a gross tax charge on the consideration, so the Spanish tax authority will apply the gross formula to know the deductible amount. 20,000 divided by 1 minus, okay, 222,222 is 222. In this way, its positive adjustment will have been carried out within the 222,000 since the computable income has increased, and we will be entitled to deduct it. Operation between related entities and persons, interest, expense, deduction, limitations. Now, the standard that regulates transactions between entities and related persons in Article 18 of the corporate tax law, they were previously known as transfer prices, and were those transactions between related companies, or between partners, which created a convenience price. The transaction carried out between these related persons or entities will be valued at their market value. Market value is the value that would have been agreed upon for independent persons or entities upon conditions that respect the principle of open competition. Now, that, in other words, you can't do this little sweet deal with your cousin and say, oh, I sold that for like 10 cents, when in reality, like, it's $10,000, something like that. Anyway, the tax administration will be able to verify these transactions as being valued at their market value, and will make, if appropriate, the valuation adjustments that will be applicable to the transaction subject to this tax, to the personal income tax or non-resident income tax that had not been valued at the normal value price, with the documentation provided by the taxpayer and data and information available. In other words, a Spanish tax agency may verify that the valuation is in accordance with the law. Now, the corporate tax law states that the following will be considered persons or entities. And here they are. Here comes now the list. Let's have a quick look here. Good. A company and its partners or participating is considered a person or entity. A company or its director and its directors, administrators, except for the remuneration for exercising their function. A company and their spouses or persons directly or collaterally related to by virtue of either blood or affinity up to a third degree to the partners or shareholders of another company. In those cases in which both companies, like it's just like, oh my goodness, it's like your cousins and your cousin Vinny and Uncle Vito and all that sort of thing. Two companies that belong to a given group. Okay, so yeah, this is the sort of swindle that some people we know have undertaken. Okay, a company and board members of administration of another company in those cases in which both companies belong to a group. A company or another company in those cases in which the first company indirectly holds at least 25% of the shares of the second company. Or two companies in which the same partners or their spouses or persons directly or co-related collaterally related by virtue of either sanguinity, blood, or affinity up to the third degree, directly or indirectly holding at least 35% of the social capital or company funds, a company resident in Spanish territory, and its permanent establishments are abroad. In those cases in which the relationship is defined according to the relationship of the partners and shareholders within the entity, they must hold 25% or more. This mention of administrators will include de jure and de facto administrators. And notice the use of the word administradores. Yeah, right, no. Okay, the methods that a corporate tax law establishes to determine market value are A, comparable uncontrolled price methods, comparative price of the good or service in a transaction between partner entities linked to the price of an identical good or service or with similar characteristics in a transaction between independent persons and entities in comparable circumstances, making it necessary adjustments to obtain equivalence and to take into account the special characteristics of the transaction. The cost plus method. The usual margin is identical or similar transactions with independent persons. Of course, what this means is you can't say, oh, yeah, like we're going to do this little transaction, but there's going to be like 50% commission, where everyone else, like the commission is normally 10%, right? You can't just say, oh, no, 50%. No. Just because it happens to be cousin Vinny or something like that. Yeah. This is the sort of corruption that you see in politics. Anyway, and that's how they do it. Or the margin that an independent person or entity applied to comparable operations is added to the acquisition value or production cost of the good or service. The necessary adjustment to obtain the equivalent and to take into account the special characteristics of the transaction may be made. Now we look at resale price method. Now this margin applied to the reseller in identical or similar transactions with independent persons or entity, or in its option, the margin that independent persons or entities applied to the operations is subtracted from the sale price of a good or service. If necessary, the adjustment to obtain equivalence and to take into account the special characteristics of the transaction may be made. All of these things we're looking at is like to keep people from swindling or try to keep them from swindling. Anyway, never mind. Profit split method. Each person or entity is assigned to carry out one of several operations together. The common result will be divided into persons or entities proportionately based on the criteria that adequately reflects the conditions that would have subscribed persons or independent entities in a similar circumstance. E. The transactional net margin method. Transactions carried out with a related person or entity are attributed to the net result calculated on cost sales of the amount that is the most appropriate according to the characteristics of the identical or similar transactions carried out between independent parties. The necessary adjustments are made to obtain the equivalence and to take into account the special characteristics of the transaction. The selection of the valuation method will take into account, among other circumstances, the nature of the related transaction, the availability of reliable information, and the degree of comparability between related and unrelated transactions. When the above methods cannot be applied, other generally accepted methods and valuation techniques that respect the principle of free competition may be used. Regulations on corporate income tax include the standards that must be followed regarding valuation rules and procedures of the resolution of proposals in articles between 17 and the 30th and are summarized as shown. Subscription of the proposal and withdrawal. The proposed valuation must be endorsed by all the related persons or entities that are going to carry out the transaction. The withdrawal of any of the parties determines the completion of the product. Documentation and information prior to the proposal, the identification of persons or entities in it, a description of the transaction, description of the contents of the proposal, presentation of the proposal document, technical, legal, economic, financial descriptions of the operation, descriptions of the valuation method. Yes. Justification for proposed valuation method, value of values are described from the application of the method, identification of the companies in the same market, and prices that apply in comparable transactions, distribution between parties of the result of the transaction, estimated valuation proposals or in the process of being proposed before tax administration, identification of the transactions carried out by related entities that are not affected by the valuation proposal. See if there's some more. Examination of the proposal, evidence, and allegations. The Spanish tax authority will examine the document with the card, report, supporting documents. Taxpayers may submit claims, provide the documents and supporting documents they consider relevant. Taxpayers may propose the practice of evidence by any of the means administered by law, and the Spanish tax agency may apply the results it considers necessary. Decision effects and resources. The decision that ends the procedure may, one, be to approve of the proposal, approve of an alternative proposal made by the taxpayers during the process, or dismiss the proposal altogether. This decision will be justified, irrevocable, and applied to the Spanish tax agency and taxpayers. These articles on the corporate tax law state that in the deduction of the expenses of services between related persons and entities, it shall be required that the services provided have and may have an advantage or utility to the recipients. In the case of services provided jointly in favor of several related persons or entities, and provided that the individualization of the service received or the quantification of the determining elements of their remuneration is not possible, then the distribution of the total consideration of among the beneficiary persons or entities will be possible according to some distribution rules that meet criteria of rationality. Right. This criteria will be satisfied with the applied method, taking into account, in addition to the nature of the service, the circumstances in which it's provided, the benefits obtained or likely to be obtained by the target persons or entities. The taxpayer may consider that the agreed value corresponds to the market value in the case of provisions of service by a professional partner, legal person, or related entity, and so on. The taxpayer may consider the agreement, the related entity following requirements are met. More than 75% of the income of the company comes from the carrying out of the activity. The amount of remuneration corresponding to all professional partners for the provision of service to the company is not less than 75% of the result prior to the deduction of the remuneration corresponding to all professional partners for the provision of services, and that the amount of the remuneration corresponds to each of the professional partners to meet the following requirements. One, that it is determined based on the contribution made by them to the good performance of the company. The qualitative and quantitative criteria applied should be in writing. It's not less than 1.5 times the average salary of employees of the company that perform functions analogous to those of the professional parties in the company. In absence of the latter, the amount of the aforementioned remuneration may not be less than 5 times the public income indicator of multiple effects. Failure to comply with the results established in number 2 in relation to any of these professional partners will not prevent the application of the provisions of this section or to the other professional partners. And in the case let me see. Wait. Sorry. Where's the words in the case? Must be consequences. Oh, in the case of agreements for the distribution of cost of goods and services signed between related parties and entities, the following requirements must be met: that the participation persons or companies that sign the agreement must access the property or other right that has similar economic consequences on the assets and rights that are subject to the acquisition, production of development as a result of the acquisition. Okay. B, that the contribution of each participating person or company must take into account the profit or advantage forecast that each one expects to obtain the agreement based on criteria of rationality. And C, the agreement must contemplate the variation of their circumstances, participation persons or companies established in the compensatory payments and adjustments deemed necessary. Limitations of interest expense deductions. Net financial expenses is defined as the excess of interest expenses with respect to the income derived from the transfer of one's own capital accrued by the taxpayer to a third party. Article 16 of the Corporate Tax Law regulates the limitations of interest expenses with 30% of the operating profit for the year. The operating profit will be determined based on the operating result of the profit and loss account for the given year, in accordance with the Code of Commerce and other accounting regulations. To determine the results, the following will be eliminated: depreciation of fixed assets, subsidies for non-financial assets, impairment and gain or loss on disposal of non-current assets. On the other hand, financial income from equity instruments will be added as long as they correspond to the dividends or shares in profits of the company in which the percentage of direct or indirect participation is at least 5%, or the acquisition value of the participation is higher than 20 million euros. The limitation will not be applicable A, to credit institutions and insurers, that those companies whose voting rights correspond to them and whose activities consist of issuing and placing financial instruments in the market to strengthen the regulatory capital and financing of such companies. Mortgage securitization funds and assets securitization funds will also be receive this treatment, and in the tax period by which the entity determines, unless it is a result of a restructuring operation. Discovery of hidden assets in International Corporate Tax, Module 2, Part E. Hidden assets are assets that have been acquired through undeclared income and whose ownership corresponds to the taxpayer, but are not registered in their accounting books. Concealment or non-declaration of hidden assets, fictitious or non-existent debts, are regulated in Article 121 of the Corporate Tax Law. Presumption of concealment of income. Presumption. Undeclared income is assumed when the taxpayer has assets that are not registered in their accounting books or are partially registered, when fictitious or non-existent debts are recorded in the accounting books, and non-registered assets remain with the possession of the taxpayer. On the other hand, the concealment of income will not be presumed when the taxpayer certifies that their assets and rights have been acquired through declared income or income obtained in tax periods with respect to those that did not have the status of taxpayer of this tax. For example, our company does not account for the purchase of office equipment valued at 25,000 euros. To acquire this material, we incur a debt of 10,000. When this purchase transaction is discovered to be unposted, the following amount will be charged to the oldest tax period of the non-prescribed ones, and it will look like this. The income amount is as you can see, the difference between those two numbers, which is 15,000. Capitalization reserve is regulated by Article 25 of the Corporate Tax Law. It is basically concerned with the non-taxation of the benefits for constituting a restricted reserve. This reserve aims to increase self-funding, increase its importance with respect to external funding, and essentially restructure the company. This reserve can be endowed by companies that pay taxes at the general tax rate, those that apply to the type of newly created companies or the type of credit companies and oil receivers. These entities will be entitled to a reduction in the tax base of 10% of the amount of the increase of their own found funds, provided that the following requirements are met. That 1, the amount of the increase in equity is maintained for 5 years from the end of the tax period to which the reduction corresponds, except for the existence of accounting losses of the company. 2, a reserve is set aside for the amount of the reduction which must appear on the balance sheet with an absolute separation and appropriate title and will be unavailable during the term provided in the previous letter. For these purposes, it will be understood that this reserve has not been made available in the following cases. A, when a partner or shareholder exercises the right to separate from the company. B, when the reserve is totally or partially eliminated as a consequence of transactions to which the special taxing regime established in Chapters 7 of the Title 7 of this law is applicable. And C, when the company must apply the aforementioned reserve under the legal obligation. The right to the reduction foreseen in this section cannot in any case exceed the amount of 10% of all the positive tax base of the tax period prior to the reduction to the integration referred to in Section 12 of Article 11 of this law and the compensation of negative tax base. However, if there is not enough tax base to apply the reduction, the pending amounts may be applied in the tax period that end in the 2 years immediately following the end of the tax period in which the right of reduction has been generated, together with reduction that may correspond where applicable by applications of the provisions of this article and for the corresponding tax period, and with a limit established by the previous paragraph. According to Section 2 of Article 25, the increase of the equity fund will be determined by the positive difference between equity funds existing at the end of the year without including the result of year-end closing, and those funds existing at the beginning of the year without including the reserve of the previous year. The following will not be included in equity funds: member shares, capital increases through capitalization of loans, increase in equity capital for its own shares, restructuring programs, operations, legal or statutory reserves, reserves for investments in the Canary Islands, one's own funds corresponding to the issuance of compound financial instruments, equity funds for variation in deferred tax assets derived from the decrease or increase of the tax rate. Here are some examples. Capital, legal reserve, so on and so forth, voluntary reserves, result of the year, total equity. The increase in equity is determined by the positive difference between their own funds existing at the end of the year without including the results of the year, and equity at the beginning of the year without including the results of the previous year, excluding the calculation of legal reserve in accordance with the provision of Article 25 of the Corporate Tax Law. Thus, their own funds increase of 157,000 euros, which is the difference between these two amounts. Let's go quickly up and look at those. Where did we get those numbers? Therefore, the reduction in the tax base of the capitalization reserve is this. As long as a restricted reserve is provided for the aforementioned amount, it is maintained for 5 years, and the increase of 157,000 in equity is maintained during that same time unless the company has accounting losses during the same period. Set off for negative taxable income. Negative tax base has been subject to assessments or self-assessments, may be compensated with the positive income of the following tax periods with a limit of 70% of the taxable base prior to the application of the capitalization reserve established in Article 25 of this law and its compensation. And in any case, a negative tax base may be offset in the tax period up to the amount of 1 million euros. Negative tax base cannot be offset in the following circumstances. A, most of the share capital or the right to participate in the results of the entity that has been acquired by the person or company or by a group of related persons or companies after the conclusion of the tax period whose tax base was negative. B, the person or companies referred to in the previous paragraph had a participation of less than 25% at the time of the conclusion of the tax period whose tax base is negative. C, the acquired company is in one of the following circumstances: that it did not perform any economic function within 3 months prior to the acquisition, that it carried out a different or additional economic activity in the 2 years after the acquisition, which determined the net amount of turnover in the subsequent years higher than 50% of the average amount of turnover of the company corresponding to the previous 2 years. Different or additional activity is understood as an activity into which a different group than the one previously performed under the National Classification of Economic Activities. Or three, that it is a legal entity in the terms established by Section 2 of Article 5 of this law. Four, that the entity has been de-recognized in the tax entities index by application of provisions of letter B of Section 1, Article 119 of this law. The company's prior tax base can be positive in this case until the amount is exhausted. It could be used to offset negative tax bases from previous years. Negative, and in this case, it determines that the tax base for the year could either be offset by further future positive income or exercise to the right of the return of the payments made on account. Now, taxation, income reduction from tangible, intangible assets, types of tax, and total taxable liability. 2.2.1, income reduction from tangible assets. The income from the transfer of the right to use or exploit patents, drawings, or models, blueprints, secret formulas, or procedures, rights over information relating to industrial, commercial, or scientific experiences will be included in the tax base by 40% of the amount when the following requirements are met. The transferor has created at least 25% of the costs of the assets to be transferred. And the transferee uses the use or exploitation rights in the development of an economic activity, and the results of that use do not materialize in the delivery of goods or provisions of service by the transferee that generate tax-deductible expenses in the transferring entity. Provided in the latter case, the entity is related to the transferee. Interesting. The transferee does not reside in a no taxation company or a territory or qualified as a tax haven unless it is located as a member state of the European Union and the taxpayer proves that the transaction responds to valid economic reasons and that they carry out economic activities. Now, when the same assignment contract includes supply of ancillary services and the corresponding considering must be differentiated. Or E, that the entity has the necessary accounting records to be able to determine the direct income and expenses corresponding to the assets subject to assignment. Now, in no case should this entitle the reduction in income derived from the transfer of the rights of usage or exploitation, or of the transmission of trademarks, literary, artistic, or scientific works, including films, or personal rights subject to transfer, such as the rights of image or of computer software, industrial, commercial, and scientific equipment, or of any other right or asset different from those indicated in the first paragraph. The general tax rate for taxpayers of this tax is 25%. However, newly created entities that carry out economic activities will pay in the first tax period in which the taxable base is positive and in the following at a rate of 15%, except if, in accordance with the provisions of this article, they must pay taxes at a lower rate. The 15% tax rate envisioned in this section will not be applicable to those entities that are considered as an equity entity. Generally, the tax rate included in the corporate tax law are the following. Corporate companies with a preferential tax application will be taxed at 20%, except for the extra cooperative results, which will be taxed at the general rate. Don't forget what the general rate is. I believe it's 25%. Anyway, credit unions and roll banks will be taxed at the general rate, except for the extra cooperative results, which will be taxed at the rate of 30%. Companies to which a tax regime established in that law of December 23rd apply, the tax regime of non-profit entities and tax incentives for patronage will be taxed at 10%. Interesting. The following will be taxed at 1%. Investment companies with variable capital regulated by the law of November 4th on collective investment institutions, providing that the number of shareholders required is at least the number provided in 9.4. B, the investment funds of the financial nature provided for the aforementioned law, provided that the number of participants required is at least as stated in 5.4. Real estate investment companies and real estate investment funds regulated in the aforementioned law, other than those provided for in the letter D below, provided that the number of shareholders or participants is at least as provided by Articles 5.4 and 9.4 of this law, and whose exclusive object is the investment in any kind of urban property for its lease. The application of the tax rate provided for this in this section will require that the real estate that integrates the assets of the collective investment institutions referred to in the previous paragraphs are not disposed of at least 3 years after their acquisition, unless exceptionally the National Security Markets Commission approves. Here again, D, the real estate investment company or real estate investments fund, regulated by the collective investment institutions that, in addition to meeting the requirements set forth in letter C, carry out the activity of housing promotion exclusively for the use or leasing and comply with the following conditions. That 1, the investment in real estate that affects real estate development activity may not exceed 20% of the total assets of the company or real estate investment fund. 2, that the activity of the real estate investment or leasing must be subject to separate accounting for each property acquired or promoted. 3, the real estate derived from the promotional activity must be leased or offered as a lease by the real estate investment company or fund the minimum period of 7 years. Now we come to E, the regulatory fund of the mortgage marketplace established by Article 25, regulating the mortgage market. Now, pension funds, regulated in the restated text law of the regulation of pension funds, will be taxed at 0%. Credit institutions will be taxed at 30%, as well as those which explore, research, and exploit deposits and underground storage of hydrocarbons. Oh, okay. In terms established by the hydrocarbon sector. Gross tax charge and double taxation. When the tax rate is applied to the positive tax base, the gross tax charge is obtained. The gross tax charge is determined by the application of the tax rate corresponding to the tax base. As seen, the corresponding tax rate is regulated by the corporate tax law, and in this way, tax base times tax rate equals gross tax charge. Deductions of the gross tax charge are try to avoid the existence of a double taxation that occurs when the profits generated by the company after taxation, taxing under the corporate tax, are again paid by the person or the partner if it is a physical person, and in this case pays the personal income tax again, or by the corporate tax if it is a legal person, either by receiving a dividend or transfer of shares. The corporate tax law distinguishes between several types of deduction, and among them are deductions to avoid legal double taxation for benefits abroad, deduction to avoid internal economic double taxation for shares or dividends paid by a non-resident entity. Now below is a short summary of double taxation. Since there is an increasing number of business transactions between different countries, international regulations try to balance or standardize taxation so that there are no significant differences between countries. Without ignoring the sovereignty of each country, the recommendations of the international institutions increasingly permeate the tax legislation. So the OECD, the IMF, and so on, International Monetary Fund. For this reason, bilateral or multilateral agreement between countries are also signed. The European Union law is not international, but it is integrated into the regulatory system of the member states. Here are its principles. Their direct effect. Its rules have a direct effect on the national legislation of the member states. Primacy. The law of the European Union prevails over the internal regulations of a member state. Yes, okay, that would mean that the Belgian conclave has more than any individual country. Primacy. Okay, subsidiarity. This is a shared competence. The European Union's action is justified only when the intended objectives cannot be sufficiently achieved by the member states. The EU tax policy consists of two parts: direct taxation, which is the exclusive competence of the member states, and indirect taxation, which affects the free movement of goods and provisions of services throughout the single market. Although direct taxation is exclusive to the member states, the EU establishes some harmonized rules for company taxation. In Spain, for example, the network of international agreements has been expanded and updated to avoid double taxation, and tax laws on internal taxation have been updated. Since 1998, the legislation of non-resident taxation has been enacted independently of the personal income tax and the corporate tax law. However, regulations are brief and do not provide for all matters, so in many cases the PID is still referred to in the case of the natural person, and I think that could be personal income tax, not 100% sure. The corporate tax law in the case of companies. In fact, the regulations established is that must be harmonized with these two laws, in which case they are not included in the text. Regarding the double taxation of companies, the model suggested by the OECD have the most influence for international tax relations. Currently, its Model Tax Convention is the basis for internal agreement. In addition, it includes recommendations of its reports, base erosion and profit shifting on double taxation, but also on the tax practices that have been observed in international economy and seek to take advantage of the discrepancies, loopholes, or advantages of certain countries where the legislation is not fully developed or there is no legislation. The report locates identified bad practices and includes recommendations that the country can implement into their laws, and that is why this model is so influential and relevant. Under the Model Tax Convention and integrated in the measures to avoid the erosion of tax base and the transfer of benefits in the agreement, the signatory states must carry out the mechanisms for these recommendations to take effect. Spain has included most of the double taxation agreements in the agreement. Spain has agreements to avoid double taxation with the following countries. Oh, yes, quite a few. Wow, there they all are. Oman, that's so interesting. Okay, yeah, there you go. This looks like a lot. So let's see if Germany's in there. I'm pretty sure Germany would be in there. Are you doing them? They're not even doing them alphabetically. Well, that is a bit of a shame. Denmark, sure. Ecuador, yeah. Poland, I think Poland's inside NATO. United Kingdom, whoa, there you go, eh? I am looking for Germany, not finding it. That's a lot of countries. Okay, Canada even. Wow, that's pretty impressive. We're not even finished yet. Oh my goodness, yes. Oh my goodness. Okay, we better go look for that Germany thing again, all right? Okay, come on. Clickety boo. The mouse ran up the flue. Okay, I'm not seeing Germany in that group. Wow. United States of America. Interesting. Okay. Not seeing Germany in that group. Okay. Maybe you don't have to mention. But you know what? Oh, there she is. There's Germany. All right, there we go. We're in a good place. All right. Deduction to avoid double taxation, tax borne by the taxpayer. This deduction unilaterally corrects the international double taxation that is generated when a social entity obtains an income that is taxed by the same tax in Spain and abroad. Article 31 of the Corporate Tax Law establishes that when the tax base of a taxpayer includes income obtained and taxed abroad, the lower of the two following, will be deducted from the gross tax charge. Oh, I was saying that backwards. Yeah, I always thought you had to pay the higher of the two taxes. Anyway, but it will be deducted by the effective amount of taxes paid on the grounds of a lien of an identical or analogous nature of this tax. Tax not paid under exemption, bonuses, or any other tax benefit will not be deducted if an agreement is applied to avoid double taxation. Deductions may be exclude corresponding tax. The amount of gross tax charge would be correspond to pay for the aforementioned income in Spain if it has been obtained in Spanish territory, and the amount of the taxation paid abroad will be included in the income for the purposes set forth in the previous section, and it will also be part of the tax base, even if it is not fully deductible. The deductible expenses is that part of the amount of tax paid abroad that is not subject to deduction in the full gross tax charge for application of the provisions of the previous section, provided that it corresponds to business activities abroad. When the taxpayer has earned income from various sources from abroad within the tax period, the deductions will be made by grouping income from the same country, except for the income earned through permanent establishment abroad, which will be counted separately for each one. The negative, starting to look a little bit promising. The negative income obtained abroad through a permanent establishment will not be included in the tax base unless the transfer of the permanent establishment or termination of the activity. In the case of permanent establishment that has been obtained negative income that has not been integrated into the tax base of the entity in previous tax years, the positive income obtained subsequently upon the amount of those will not be integrated. To qualify for tax deduction, a company must reside within the Spanish territory or pay for this tax. In addition, the income earned and recorded abroad must be included in the tax base. For example, our organization receives a gross income of 28,000 euros for providing our services in France. In addition, we have 5,390 euros for a tax similar to the corporate tax. We have paid, what will this be the reduction in the internal double taxation while accounting? What should we make? Well, let's find out. Deduction is the lowest of the two amounts. Yeah, the effective tax paid in France is this. The amount that would have been paid in So it seems that so I write. It's always the lesser of the two that you can get to take off your taxes. Yeah, and you have to pay the rest. You always end up paying the higher of the two numbers. Right on. And the accounting department that will have to be made will be positive, as is the amounting to what the tax is paid. So as 5390 is included in Article 31. Right on. Deductions to avoid double taxation for dividends or shares, benefits paid to a non-resident entity. Now, when dividends or shares in the benefit paid by a non-resident entity of Spain are included in the tax base, the tax effectively paid by the latter will be deducted from the benefits charged for which the dividends were paid. And in this corresponding amount, such dividends, provided that this amount is included in the tax base of the taxpayer. The following requirements should be met for this tax deduction to apply. The direct and indirect shareholding of the non-resident entity is at least 5%, or acquisition value of the shareholding is more than 20 million euros. The shareholding has been held uninterruptedly during the year prior to the day on which the benefit is distributed, or failing that, it is maintained for as long as is necessary to complete 1 year. And for this calculation of this period, the period in which the participation has been uninterruptedly owned by other entities that meet the circumstance referred to in Article 42 of the Code of Commerce, has been part of the same group of companies regardless of the resident and obligation to file consolidated financials in statements. And in this case of distribution of reserves, the designation contained by the social agreement will be considered, and failing that, the last amount paid to these reserves will be considered applied. A dividend or shares and profits will be considered as derivatives of securities representing the capital of the own funds of entities, regardless of their accounting consideration. The deductions provided for this section will be applicable if the dividend or profit sharing are collected because there is a contract regarding company stock, and therefore taxes related to receiving this amount can be charged to expense in the income statement. The entity receiving this amount may apply the deductions provided for in the aforementioned section as long as it keeps the accounting record of these two securities and they meet the conditions established by the previous section. The tax paid by the entities directly invested by the company that distributes and the dividend by those that in turn are directly invested by them, and so on, and then part of the attributable to the benefits for which the dividends are paid as long as the indirect share in these entities is at least 5%. And the requirement referred to in the previous section is complied with regard to the time the shares are held. Now, residence in Spain. As seen in point 2.2, to determine if a company is considered as a resident or not in Spain, Article 8.1 should be seen, which states that entities that comply with the following requirements will be considered residents, that they have established in accordance with the Spanish law, that they have their registered office in Spanish territory, and this happens when the management of all the activities is located in Spanish territories, considering that the tax agencies may presume that an entity located in the country or territory of no taxation or considered as a tax haven has its residence in Spanish territories when it is principal, directly or indirectly consists of assets located or rights that are fulfilled or exercised in Spanish territory, or when its main activity is carried out in it. Unless this entity proves that effective management is carried out in that territory or in that operation, responds to economically valid reasons and substantial business reasons that are not only the management of securities, and other assets. So there are two ways of tax liability with permanent establishments. Taxpayers who obtain income through a permanent establishment located in Spanish territories will be taxed as a total income attributable to said establishment, regardless of the place where it was obtained or produced. Without a permanent establishment, taxpayers obtaining income without intermediation of a permanent establishment, mediation will be taxed separately of each full or partial accrual of income subject to tax without any compensation between them being possible. Now we come to permanent establishment. An entity will be considered to operate through a permanent establishment in Spanish territory when its facilities or workplace of any kind in Spain in which all or a part of the activity is carried out continuously, or indeed when acting in Spain through an authorized agent to contract on behalf of the non-resident entity, provided that the agent exercises such powers regularly. So in this way, the headquarters, branches, offices, factories, workshops, warehouses, or other establishments, mine, oil or gas wells, quarries, farms, forestry, or livestock, or any other place of exploitation or extraction of natural resources, and construction, installation, or assembly works whose duration exceeds 6 months shall be considered a permanent establishment. Income attributable to permanent establishments are the following: returns on the economic activity or operation developed by such a permanent establishment, returns derived from fixed assets affected by it, capital gains or losses derived from the fixed assets affected by the permanent establishment. On the tax base of the permanent establishment will be established in accordance with the provisions of general tax regulation. Tax allowances and deductions to encourage the pursuit of certain activities. Aiming to reduce taxation on certain incomes or taxpayers, the law establishes certain allowances, Articles 33 and 34 of the corporate tax law, and these are the most important features. Like, this isn't really an extensive list at all, it's just like important features only. Income tax allowances in Suiza or Melilla. I'm almost starting to say that, like yeah, okay. Anyway, this allowance is regulated by Article 33 of the corporate tax law. It sets out different regulations for the total set of entities that operate effectively and materially in Suiza or Melilla, or for fishing entities or marine navigation. You know what? This 50% allowance will be granted for the other part of the gross tax charge that corresponds to income obtained in Suiza or Melilla by entities that operate effectively and materially in such territories. So the income obtained is understood to be the income that corresponds to activities that determine the closure of a trade cycle with economic returns in those territories. So tax allowance for providing local public services. Okay, this allowance is regulated by Article 34 and it provides that it will have a 99% allowance on the part of a gross tax charge. That's amazing. That corresponds to the income derived from providing any of the services of competency for local, territorial, municipal, provincial entities, except that they are exploited by mixed companies or companies of entirely private capital. Starting to wonder about places like, these thrift shops. They're really private entities. Anyway, the allowance will be applied to when the service referred to in the previous paragraphs provided by entities wholly dependent on the state or the autonomous communities. Another incentive of the corporate tax law is the deductions that certain economic activities considered benefits not only for the company but for the whole society of the country. However, the reduction of tax rates is gradually linked to the disappearance of some of the deductions to encourage certain activities that existed until now in the tax as already happening with environmental incentives. Article 35 corporate tax law includes deductions for activities of research and development and deductions for technical innovation, which is known as R plus E plus I. Deduction for research and development activities. Well, a research and development activity shall be entitled to a deduction of the gross tax charge. Research and development activities, our little friend Elon Musk, for example, are activities that, in the original and planned manner, look for new knowledge, better understanding of the scientific and technological field, and of its application to the manufacture of new products, materials, production processes, or their application to pre-existing systems to improve them. Putting this research and development into the plan, arrangement, or design, or creating a prototype, as long as they cannot be commercialized or exploited commercially, will also be considered research and development. Deductible base. The deductible base consists of the amount of research and developmental expenses of, where appropriate, of the investments in tangible and intangible fixed assets, excluding business buildings and land that are made in Spain or any member state of the European Union or the European Economic Area. The deductible base will be reduced by the amount of the subsidy received by the promotion of such activities and attributable as income in the tax period. And now we have the deduction percentages. 25%, number one, the expenses incurred of the tax period for this concept. However, if the expenses for research and development activities in the period are higher than the average of those incurred in the previous 2 years, percentage established for the previous will be applied up to an average and up to 42% over the excess. With respect to this, in addition to the appropriate deductions, an additional reduction of 17% of the amount of personnel expenses of the entity corresponding to qualified researchers assigned exclusive to these tasks will be applied. 8% of investments in tangible and intangible assets, excluding buildings and land, provided that they exclusively used for research and development activities. Now we have deductions for technological innovation activities. Activities for technological innovation entitled companies to deduct the gross tax charge under the conditions established in this section. And in this case, a technological innovation is any activity whose result is a technological advance in a new product or production process. It includes new products, processes in a plan or design, prototypes that cannot be used commercially, initial demonstration, products, etc. Deductible base. It consists of the amount of the expenses of a year of activities for technological innovation in the following concepts: technological diagnostics activities aimed at the identification, definition, and orientation of an advanced technological solution, regardless of the results. And 2, industrial design and production processes, engineering, including plans, drawings, and support design to define descriptive elements. Production of textile samples, footwear, tanning, leather goods, toys, furniture, and wood. Acquisition of advanced technology in the form of patents, licenses, know-how, and designs, except for those acquired from persons or entities linked to the taxpayer. Aha! There's no good old Cousin Ralph again, bud. Oh, yeah, Cousin Ralph. Yeah. The amount of 1 million euros cannot be exceeded. Okay. Certificate of compliance to 1 million euros seems to be an important number for these peaks. Yeah. And of course, if things go completely out of control, 1 million means pretty much nothing. That's happened in Germany with the Reichsmark. But anyway, I digress. Certificate of compliance with the quality assurance standards of ISO 9000, GMP, or other series, excluding expenses corresponding to their implementation. Technological innovation expenses that are part of a deductible base must correspond to activities carried out in Spain or in any other member state of the European Union or the European Economic area. And in the deductible base, the amount of technological innovation expenses will be reduced by the amount of subsidies received. Good point. Received for the promotion of these activities and attributable as income in the tax period. So the deduction percentage, 12% of the expenses incurred in the tax period for this concept. And here's some exclusions now. The activities considered to be following will not be considered research and development activities or technological innovation. A, activities that do not imply significant scientific or technological development. This is obviously a judgment call. B, the industrial production activities and service provided or distribution of goods and services. C, exploration or prospecting for mineral. That's interesting. That's getting really interesting because that's kind of like with this whole little direction. Yeah. I'm pretty sure that used to be something. Anyway. That's not interesting. Okay. Deductions for investments in cinematography productions, audiovisual series, or live performances. That's interesting. Or is this a new section? Okay. I just don't know if that comes in. I need to find out if this is a new section or what the story is. Okay. It looks to me it is hard to tell. But that's significant about the hydrocarbons. It really is. It's de-incentivizing oil and natural gas. Yep. Part of the big plan, bud. Wow. Okay, anyway, this section, I don't know if it's part of the other. I'm going to find out, I suppose. 36, the deductions that affect audiovisual production, investment in Spanish audiovisual content that allows for preparation of physical support prior to the industrial production will entitle to a deduction of 20% on the first million of the deductible base and 80% of the excess. The deductible base consists of the total cost of production and expenses for copying and advertising and promoting at the producer expense up to a limit of 40% of the production costs, and the amount of the subsidies received must be reduced to this base. Anyway, if the production is international and takes place on Spanish territory, there is a deduction of 15% if the expenses are at least 1 million euros. The deductible base consists of the expenses of the creative staff, provided that they have tax residence in Spain or in member states of the European Economic Area, within a limit of 50,000 euros per person, and or of the expenses derived from the use of technical industries and other suppliers. In the case of the production or exhibition of live performances of performing and musical arts, there is a deduction of 20% on the expenses for these activities. In these cases, the deductible base is made up of the direct artistic, technical, promotional costs reduced by the amount of subsidies, because the subsidies may be received for the performance. Deductions for the creation of employment. Okay. So that seems to be an 11. Yeah, so it wasn't part of the other thing. It wasn't an exclusion. There are deductions for companies that help create jobs. Article 37 uh, of the corporate tax law states that the entity that hires the first worker who is under 30 years old with a permanent contract to support entrepreneurs may deduct 3,000 euros from the gross tax charge. In addition to this deduction, if the company has less than 50 workers when it hires an unemployed person receiving unemployment benefit from the permanent contract to support entrepreneurs, they may deduct 50% of the gross tax charge of the lower of the amounts, following amounts, the lower of these two, or three, or four, however many it is. Judges do. Okay, so the amount of the unemployment benefit the worker had to receive when hired, the amount corresponding to 12 months payments of their unemployment benefits. Let's have a look and see. So you're hiring this unemployed person. Now it would go to 12 months. This deduction may only be applied if the hired worker received the benefit for at least 3 months before being, okay, they have to be really on the ELI or something like that. Anyway, regarding part-time work contracts, these deductions will be applied proportionally to the agreed working hours. Deduction for the creation of employment for workers with disabilities. Aha! Organizations that hire workers with disabilities can benefit from the following deductions included in Article 38. 9,000 euros for each person year of increase in the average number of workers with disabilities in a degree equal to or higher than 33% and lower than 65% hired by the taxpayer. Experience during the tax period with respect to the average workforce of the same nature of the previous immediate period. Wow, 12,000 euros for each person year of increase in the average number of workers with disabilities in a degree equal to or higher than 65% hired by the taxpayer, experienced during the tax period with respect to the average number of workers in the same nature of the previous immediate period. Special system for smaller and medium-sized enterprises. Corporate tax law establishes a series of tax incentives for smaller entities. This special system is really regulated by Articles 101 to 105. Tax incentives established in this section will apply provided that the net amount of turnover of the immediate previous tax year was less than. That's a pretty big, small, yeah. These incentives will be applied to 3 immediate and subsequent tax periods to the tax period in which the entity has a turnover of 10 million euros, providing that this entity or group of entities meets the requirement to be considered as small or medium size, both in that period and in the 2 tax periods prior to the latter. The tax incentives for small entities, okay, where you make a difference. Freedom of amortization if certain requirements are met. New tangible and intangible assets may be amortized based on the coefficient resulting from multiplying by 2 the maximum straight line depreciation coefficients, understood, established by the officially approved amortization schedule. Loss of depreciation of credit to cover risk of insolvency will be deductible up to a limit of 1% of the existing debtors at the end of the period. Tax-based leveling out reserve. A negative tax-based leveling out reserve involves reduction by the same up to 10% of its amount. This measure has more incentive effective than the so-called carryback regarding the treatment of negative tax bases, since it reduces the taxation of the benefits of special tax periods within respect to the negative tax base that will be generated in the following 5 years, anticipating the application of further negative tax bases. If no tax bases are generated in that period, they will be deferred for 5 years of the taxation reserve. The measure aims to encourage the competitiveness and stability of the company, allowing it to reduce its tax rate by 22.5%, and added to the capitalization reserve mentioned above, it deals with equaling the tax policy of their own and external funding. Tax management, withholding, account income, and installments. Tax management. As seen, the public administration follows a series of actions with social entities to make regulations for tax obligation effective. These actions are dependent on the procedures established by the corporate tax. As seen, the public administration follows a series of actions with social entities to make regulations for tax obligations effective. These actions are dependent on the procedures established by the corporate tax. Index of entities. The corporate tax law regulates in the Articles 118 and 119 the index of entities, to which includes the list of taxpayers of corporate tax. And it is essential elements for the effective tax management, and the state tax administration agency is responsible for it, as well as for the registration and withdrawal procedures of the entities in the index. Now we come to returns. Regarding tax returns, Article 124 of the corporate tax law states that taxpayers are required to file a corporate tax return in the place and manner determined by the Ministry of Finance and Public Administration, and it will be filed within 25 calendar days following the 6 months after the end of the tax period. If at the beginning of the aforementioned period, the matter of filing tax returns, the period has not been determined by the Ministry of Finance and Public Administration, the tax return shall be filled within 25 calendar days following the date of entry into force of the standardized establishment in the manner of filing. However, in such cases, the taxpayer may choose to file a tax return within the term referred to in the previous paragraph, fulfilling the formal obligation that has been established for filing a preceding tax period. The exempt taxpayer referred to in Section 1 of Article 9 of this law will not be obliged to file. The taxpayer referred to in Sections 2, 3, 4 of Article 9 will be required to declare all their income, both tax-exempt and non. Isn't that interesting? Self-assessment. At the time of filing, taxpayers must determine the corresponding debt and pay it in place and in the manner determined by the Minister of Finance, Public Administration. The right to apply exemptions, deductions, or any tax incentives on the tax base or on the gross tax charge will be conditional upon the fulfillment of the requirements established by the applicable tax regulation. Unless specified, stated otherwise, when after applying the tax exemption, deduction or incentives, the right to enjoy this is lost. The taxpayer must pay tax together with the tax period on which the breach of the requirements or conditions takes place. The full fee or deducted amount corresponding to the exemption, deduction, or incentive applied in previous periods, in addition to interest for late payments. In order to comply with obligations and self-assessments, the model will be completed by the Spanish tax law agency, the type of entity whose tax is assessed in these models. Provisional assessment. Now, the law establishes that a provisional assessment can be carried out by the tax administration once the self-assessment or tax return assessment has been verified and the corresponding payments have been made. When the tax return assessment is not filed at the time established by the law, or is filed with some type of error or omission, the tax administration must carry out this type of assessment. And now we come to the final assessment. Article 101 of the tax law establishes as final those assessments made in the inspection process after verification and investigation of the elements of tax obligation, and those which the tax regulations conclude finally. Collection. The normal period of payment in the voluntary period is that the self-assessment and the payments can be made by delivering goods that are part of the Spanish historical heritage. The voluntary periods it is 25 days as established in Article 125 of the Corporate Tax Law. Direct returns. The return is made automatically by the administration when the sum of withheld taxes and the payments and income made by the company exceeds the next tax worth. Article 127 of the Corporate Tax Law establishes that when the sum of withholdings, payments, and installments, payments of this type of tax is higher than the amount of installments resulting of tax assessment, the tax administration may apply provisional assessments within 6 months after the deadlines established for filing the return. Withholding payments. Withholding and payments are obligations that stand for the amount that needs to be subtracted from the payments that have been made and it has been paid to the Treasury. This amount is a payment on account for the person who receives it and who may deduct it from the corporate tax liability resulting from the tax return. Two types of income can be differentiated. Income paid in cash triggers the obligation to retain the percentage of the tax that is paid, of the cash that is paid rather. Income paid in kind. The payer must pay in cash the amount resulting from applying the withholding percentages to the value of service or good that is delivered as payment in kind. This is interesting. This is very interesting because it's basically saying, and I do hope we're not on hold, yes, that would be so embarrassing now. Yeah, good. This is sort of that whole barter thing that they had going in Newfoundland. Yeah. Without withholding agencies and income. Okay. With regard to withholding and income subject to withholdings, Article 128 of the Corporate Tax Law states that the entities, including communities of properties and owners associations, to pay income tax subject to the tax will be required to withhold or make payments of the amount that results from applying the retention percentages established at Section 6 of this article. The tax base is determined by law and to pay the amount to the Treasury in the case and manner established. Natural persons will be required to retain and pay with respect to the income they pay on their economic activities, as well as the natural person legal entities or other entities non-residents in Spanish territory that operate in it through a permanent establishment. The subject obliged to retain must file within the time deadlines, manner, and places established by regulations a declaration of the amounts withheld or the negative returns where the carrying out of these things have not taken place. Likewise, the subject will file an annual return with the content that is determined by regulations. Corresponding models of filing taxes will be approved by the Ministry of Finance and the Public Administration. The subject obliged to file will be obliged to issue under the conditions that are statutorily. I do hope it's in there. Yes, it is. Where were we? statutorily determine a certificate accrediting retention practiced on other payments made in this account. Exception from withholding. Article 128 establishes the cases in which there will be withholdings. In particular, there will be no withholding in the following: income obtained by the entity referred to in Article 9.1 of the tax law, dividends or profit sharing distributed by economic interest groups, both Spanish and European, and by joint ventures that correspond to partners who must support the allocation of the tax base and come from tax periods during which the entity or has taxed as provided by the special system of Chapter 2 of the title of Article 7 of the corporate tax law. Dividends and profit sharing and interest paid among companies that are part of the group, that is tax under the special regimes of groups of companies. Dividends or profit sharing referred to in Section 1. Income obtained by the change of assets in which the life insurance provisions in which the policyholder assumes the risk of investment to be made. Entities bound by the obligation to withhold or pay subject obliged to withhold or pay are legal persons and entities, including communities of property or owners, associations, entities that income allocation systems, taxpayers paying the personal income tax, engaged in economic activities where they receive income from carrying out their activities, natural persons, legal persons, and other entities non-resident in Spanish territories that operate in it through a permanent establishment. Tax base amounts to tax base of the payment to be made. In general, the full consideration required or satisfied will be the basis of the calculate the amount to withhold. Withholding rate and payment of the account. Article 128, the corporate tax establishes that the withholding rate of payment will generally be 19% in the case of income from a lease or sublease or buildings in those two special places or its dependencies obtained by entities residing in those territories or operating in them through the establishment or branches. This percentage shall be divided by 2. These two areas, we need to talk about those. They are some Spanish territories, I'm pretty sure, why they do get very specialized rates. On the other hand, the purpose of split payments is to anticipate the amount of the entity must pay to the public finance. You know what? I'm going to look up those two areas right now. I'm just going to do a little quick pause here. So anyway, I just found out about Ceuta and Melilla. They are not part of the mainland of Spain, but they are considered, they have members in the Spanish parliament. They're not like a protectorate or some kind of a colony. However, they are somewhat depressed. They're actually cities on the north shores of Africa. And their economies sort of need boosts, and that's why they receive these preferential tax treatments. Anyway, on the other hand, the purpose of split payment is to anticipate the amount entities must pay in the public finance. Therefore, the entity itself pays the corresponding amount. Thus, in the first 20 calendar days in the month of April, October, and December, taxpayers must make an installment payment on account of the assessment corresponding to the tax period that is in progress on the first of each of these aforementioned months. On the other hand, the entities referred to in paragraph 29 and 29 at 0 are not obliged to do so. These ones with the incredibly low tax rate. And there are 2 ways to calculate the installments, and we'll go over those right now, and then we're pretty much done. The base of calculate the installment time will be the gross tax charge, last tax payment with the due to the first day of 20 referred to, reduced in deductions and allowances which apply to the taxpayer, as well as the withholdings and income of the account corresponding to that. And when the last tax period ended in less than a year, proportional part of that amount, previous tax period will be taken into account until completing the 12 months. The amount of installment payment provided in the section will be resulting of applying the rate of 80% of the tax base. And the installment payments may also be made at the option of the taxpayer on the part of the tax base of the period of 3, 9, and 11 first months of each calendar year, according to the established rules in the corporate tax law. Taxpayers whose tax period does not coincide with the calendar year will make the installment payment on the part of the tax base corresponding to the days elapsed from the beginning of the tax period until the day before the start of each payment period. In these cases, the installment payment will be on account of the settlement corresponding to the tax period, that is, in progress the day before the start of each of the aforementioned periods. And for the option to be valid and have an effect, it must be carried out in accordance with the tax declaration during the month of February of the calendar year for which it must take effect, if the tax period to which the aforementioned option refers coincides with the calendar year. Taxpayer will be linked to this method of installment payments regarding the payments corresponding to the same and the following tax period, as long as its application is not waived through the corresponding tax declaration. However, taxpayers whose net turnover amounts to as exceeded 6 million euros during the first 12 months of the prime period, which the tax period is to which the installment payments correspond, will be obliged to apply the method referred to in this section. The amount of the installment payment will be the result of applying the percentage resulting from multiplying the tax rate rounded by default by 5/7 to the base. An installment payment will be considered a tax debt. Here endeth this rather long lesson.